finance should be an accelerator and not a brake in a company, right? Speed is as important as quality. Most companies, they pay a lot of invoice too late and a lot of invoice too early. In private markets, you can really experiment and try to change the status quo in a way that in public companies, you cannot do it.
Today on Billions, I'm sitting down with Martino Cadoni, the guy who builds IPOs. At 35, he took Moneta Moneybank public in a $749 million IPO, the biggest banking listing in Central Europe this year. At Klarna, in the middle of market chaos, he helped structure one of the largest transactions in the company's history, and now he's the CFO of DeepL, one of Europe's leading AI companies. Martino, welcome to Billions.
Thanks for having me, Guillaume. It's a pleasure.
It's not often that we discuss with CFOs, so I really want to understand a little bit more about how do you see the career of a CFO, because you went from G Capital to HSBC to Klarna to DeepL, and a lot of people assume that CFO or like the CFO job is just about like spreadsheets. So can you maybe walk me through a little bit more about like your career path and what does it take to become like a finance leader like yourself?
Yes, I mean, the first thing I always say to everyone is like finance should be an accelerator and not a brake in a company, right? So the way I see the CFO role is truly as a strategic partner to the business, right? And that's how I built my career. So I started at General Electric, GE, with their leadership programs. And these programs are a bit less known in Europe, but in corporate America, they are really truly seen as some of the best CFO factories. And substantially it works. The first 2 years after university, you get to rotate across the different areas of finance, across different geographies, across different businesses. For example, I started personally in Budapest in a G energy business. I was doing commercial finance for 6 months, working alongside sales, helping them from a finance perspective, and then moved to Italy, another different business, doing financial planning and analysis, working very closely. For example, my boss's boss back then was Thierry Pieton, which until recently was the CFO at Renault Group, and now is the CFO at Medtronic, right? So one of the major advantages of these programs, you truly get to work with some of the best people in the industry across different countries, across different businesses. So you learn a lot of new business models very quickly, right? So I've done this for 4 years, where every 4 to 6 months you get launched into a totally new space. You need to learn extremely fast. We were working truly 996. The only day off was Saturday. Sunday was a working day. And you would be assigned to a specific problem to solve, and then you had just a few months to really identify the problem and solve it and implement the change. Was like doing a mix of investment banking, McKinsey, and Harvard Business School type of things, because on top of the day job, we also had exams, right? So we had classes every trimesters, and then a lot of training on leadership, strategy, corporate finance. So it was very intensive years, but some of the most rewarding, right? And again, one of the best things was really I was surrounded by amazing leaders. For example, when I finished those programs, the head of the program was Cosima Shipchandler, who is now the CEO at Twilio, right? So you get to learn
Nice.
from the best. And the program had amazing alumni, like for example, John Elkann, who is, the president of Stellantis and one of the main heirs of the Agnellis family.
And can you
So-
share like some of the example of problem you had to solve? Because you mentioned like we were assigned like some problems and
Yes.
we need to solve. So what are these kind of problems?
Yeah, I mean, I give you a few which are very relevant. For example, when I was one of the rotation was in France. GE had just acquired a company called Convertim, and I was part of the integration team, and I was responsible to ensure that the facts and cash management of the new company as part of DE, all the processes were compliant and they were, according to SEC rules, according to IFRS, and things like that. For example, I found there were issues with the process, and we found over 20 million of opportunity in terms of FX savings, right? Another one, I was in the Netherlands. I get a call. I say, hey, tomorrow you fly to Budapest because the Hungarian government just issued a law that is banning any mortgage in non-local currency. And we want you to go to Hungary and you need to evaluate how big of a risk this is, right? So I jump on a plane, go to Budapest. I got handled like a huge database with all the mortgages in foreign currency, mainly was Swiss francs, and I had to in just 2 weeks. I had to reevaluate like a multi-million dollar reserves, which then got adjusted, that then was announced in the earnings call of GE. Another time I was in Russia, for example, we had customs compliance audit. So I had to ensure that no employees or no government officials were doing anything against the rules, right? So very different scenarios, very different areas, but you really truly learn how to solve problems first principles, how to work independently, high agency, and in a totally different environment, which I think it's for me has been a huge advantage for then transfer to private companies and more startups and scale ups because the modus operandi is very similar. We were working within GE programs with the lean startups and Toyota factory principles, which are some of the best principles if you work in a high growth environment.
Can you share like how these principles like apply in real life? Like how does that look like?
Yeah, I mean, it's like you have, for example, all things like agile working, like daily stand-ups. You have like a weekly retrospective, always really trying to, whatever you do, usually go back and understand what went well and what should have done better. Then extremely frequent feedback, like you would have every week or every other week, one-on-one, and getting feedback about your performance, what you can improve on, and what you are good at. I think this extreme frequency of feedback makes you a better person and a better professional, right? And then it's truly a lot also about processes, right? So every time we will get asked to jump into a new problem space, you had to map the process step by step. For every step, you had to identify what are the risks, what are the controls, and then how you can automate the process. So there was no AI back then, but we did a lot of automation work exactly using those principles. For example, when I was in the US, in G Treasury, we had over 100 treasury systems across GE because GE was a huge company. We had to consolidate, and after 4 months that I was there, we decided to go down from 100 to 20 systems, right? So again, same principle. There was no AI, but the logic were the same that we are, facing today.
And can you explain maybe like what's a treasury system and why like how things got improved on that side?
Yeah, I mean, so a treasury system, usually you in a big company, you have multiple bank accounts, right? These bank accounts needs to be managed. And usually there is a treasury system, which is like where you manage these bank accounts from, right? Because GE was a combination of a lot of M&A acquisitions, over time, the amount of these management systems exponentially grew, right? We obviously drives friction, extra cost because you are paying multiple providers. So there was an opportunity to consolidate and improve processes, and that's what we did.
Okay, nice. And I think at G you did around like 20 exits and IPO readiness work. But also at HSBC you were like a deputy CFO, and I think the business unit was around like 2 billion. How do you think like these corporate jobs like kind of like help you transition to startup? Like what are the things that you kept and also the thing that you had to unlearn to make that transition?
Yeah, I think also what you keep is the depth of analysis that you need to do, because the devil is in the detail when it comes to value creation, optimizing the outcome of an M&A exit or an IPO. Really, you really need to go deep. And I think one of the things that is often underrated in tech is the balance sheet. Like every time I go and work with the companies, they are obsessed about the P&L, which is great, but you should be equally obsessed with the balance sheet, because there is a lot of opportunities in a balance sheet. Obviously, in depending on the business model, some more than others. But I think that balance sheet obsession is something that has benefited me quite a lot along my journey after public companies at Klarna, but also now at DeepL. So understanding the treasury side of things, how to optimize cash flows, I think that's something which I learned during those days. Also because, for example, at HSBC, I was responsible for strategic finance, meaning deciding how much buyback we should pay, right? How much dividend we should issue, right? So managing the capital at the balance sheet of a company, which back then, was doing globally 50 billion in revenue and had a multi-trillion balance sheet. Another thing I think a lender is institutional knowledge, and also how to lead with central banks, with institutional investors, with other banks. I think that ability to build and manage those relationships is definitely helpful in my today's job. In terms of what I had to unlearn, definitely, when you move to a scale up, I think you need to understand be earlier when it's good enough, because speed is as important as quality. So you don't want to kill velocity because you want to be too perfect. So you need to get more comfortable in the good enough and just move on, right? Because speed is critical in private markets. So the one is definitely something I had to adjust. And in general, be a bit less polished, right? Because again, it's all about speed. It's all about execution, and sometimes it's better to be slightly imperfect, but be fast.
And on the balance sheet obsession, can you like explain a few things that you managed to optimize, or like if you had to go inside a company, like what are the things that you look for like directly, and where you are like almost certain that there are like optimization that you can find?
Yeah, like the basic stuff is like accounts payable, for example. I mean, all the companies that go, usually there are, because what happens in most company, you get an invoice, you look at the invoice, and you go and you pay, right? So so and and but that's wrong, because you need to understand when is the invoice due and what's the best timing to pay that invoice, right? So most companies, they pay a lot of invoice too late and a lot of invoice too early, while actually you want to optimize and pay them a due date, because if you pay too early, you are missing out on interest that can be generated with the extra cash staying in the balance sheet for longer. If you pay too late, then you are, you know, doing something which might undermine your relationship with the supplier. So optimizing the timing of the payment is usually an easy win.
Okay.
Then another thing which is usually underrated is FX fees, right? a lot of startups often they invoice only in one currency or in a few currencies, and they don't really look at the facts until very late and high stage of maturities. So I think it's important actually. There are easy wins there, right? Um, so and then things like in the checkout, you can look at authorization rates, decline rates, and so yeah, understanding anything about payments can save you a lot of times in general.
And when it comes to like FX, how exactly do you like manage the arbitrage of the currency? So if we take like the example, for example, of euro dollar exchange rate, it has changed quite a lot, like in the last year or so. So if you decide like to invoice, for example, in dollar, like do you keep like your dollar in a bank account and just like spend in dollar whenever you can, and you keep like same currency to avoid like change in FX? Or sometimes do you make arbitrage and say, okay, like the dollar is strong for now, I'm gonna change everything to euro because I'm a European company, and when dollar is weak, maybe I'm buying more dollars from my euros. Like how exactly do you make changes and arbitrage?
So first of all, from an accounting point of view, unless you are a trading company, you should not be targeting to make money, right? It's against the accounting principle. You should be trying to hedge and offset, but not to speculate on the effects, right?
Okay.
And what's critical here is if you have a good cash forecast process, you need to understand for each of the currencies what are your upcoming payments to be made in the currency and how much revenue you expect in that currency, because ideally you want to match the currency, you want to match maturity. So if you know you need a lot of US dollars next month, you can do something to optimize that, right? At the end of the day, there are FX hedging products that can help mitigate this FX risk. But often step one, which is trying to forecast how much of the currency you have in and out, is already a good amount of money saved.
Okay. Okay, really interesting. I want to go back to like a little bit of your like story at Klarna, because the IPO was a bit below like the last valuation, etc., and of the fundraise. So I want to understand like how do you approach a fundraise and how do you approach an IPO, and how can you explain like the difference of valuation that can happen?
Yeah, I mean, so there are a lot of similarities between the two processes, but obviously there are also differences. The similarities is it doesn't matter if it's an IPO or fundraising or M&A exit. I always say you need to work about this general concept of readiness, right? So, which means your house needs to be in order and across all the different areas, right? And from a finance point of view, obviously the major things, particularly if it's an IPO, if it's an IPO in the US, is you have all this SOX framework, which is a long list of compliance rules you need to comply with, right? And for the rest, you need to have financial performance, which is obviously um, positive, so it's growing. But more importantly, I think to be ready to be public, you need to have a financial performance which is predictable with a high rate of confidence, right? Because the last thing that retail investors or public investors want is a stock which is difficult to predict, right? And so it's always good to go public when you have a performance that you are growing, but you are growing in a direction which is predictable. You can then do what's the classic beat and raise. You are able to give strong guidance, and you are able to meet or beat the guidance. Because if you fail to do so, then you are in trouble as a public company, right? And so then, and to do so, you need to have an equity story, which is very clean, very clear. So people fully understand what you are doing today and what you want to do tomorrow in order to create value for the shareholders. And this process is super critical also in fundraising, right? Because it's obviously important your today performance and yesterday performance, but it's all about you being able to sell to the new investors what's your vision and how you're gonna go from where you are today to a place in 3 to 5 years where your valuation is at least 3 to 5x higher, because particularly in late stage, that's the target for the investor. The investor usually have 5 to 7 years holding period, and they want to make that 30-40% annual return, the compounds. So you need to be able, to do a 3x or 5x in late stage before you go public or before your next round, right? The valuation per se is obviously a function of different things, and one of that, unfortunately, is also economic cycles, and that's why we have seen these ups and downs in different sectors. We've seen it in fintech, right? Valuation were uh, extremely rich between 2020, 2021, and then in 2022 with interest rates going up and uncertainty in the macro and geopolitical scenarios, there was a big adjustment where some companies got impacted more than others, right? But I think each case should be also analyzed on an individual basis, because there are some drivers which are specific to a vertical or to a specific company, right? When it comes to fintech, obviously the interest rate environment plays a huge role, and that's what impacted the valuation of a lot of fintech in 2022 and beyond.
Can you explain like why the interest rate has an impact, on valuation, and basically like maybe share, the narrative from an investor perspective?
Yeah, I mean, so very simple. So what a bank or a fintech does, or let's say a lending fintech does, right? You are taking money and then you are lending to somebody else, right? So it's very critical at when you are taking money, at which rate, at which cost you are taking the money to then give it to others, right? And what happens, particularly if you are a bank, you have the ability to raise deposits from the public. So usually the cost of money for those deposits is a function of the interest rates, which is set by the central banks, right? So if I'm a bank, you have a bank account with me, and you put your money into my bank. If the central bank rates are very low, I'm able to pay you a very low interest rates, let's say, I don't know, below 1% or even close to zero back then. So for me, it's very cheap to take your money and then lending it to somebody else at good enough high rate. I can make money on the spread. But if instead of the 0 point something percent, I need to pay you 4 or 5% because that's what the market dictates, then it becomes much more expensive for me to take your money and relending. Also, because most likely the spread I'm gonna make on that loan is gonna be lower than it used to, right? And also there are demand of people also will be less interested in taking a loan if the interest rates are so high, right? So there is a funding, and that's why you had a double issue in fintech, because one is what I just described, where it's about the deposits, but also there are a lot of companies in fintech which they don't have a banking license, and therefore they cannot take deposits. So instead of taking the money from you, they take it from, for example, from private credit investors where they are much more expensive even. And so you had fintech. I've worked with some of those as an advisor where they were trying to raise private credit money, but because the interest rates were so high, they couldn't find anything below 15 or 20%. But then you cannot do much when the cost of capital is so high. Is not really a good use of capital. So yeah, for fintech specifically, high interest rates, is not a great scenario from a funding point of view, right?
And how do you edge yourself? Because obviously, like the rate is not something you decide as a company. It's like it's totally outside of your control. Obviously, you can look at the macro and try to predict a little bit where it's going, but it's very hard. So how do you edge yourself as a company?
So the key is you need to differentiate your revenue streams. And for example, that's something that Revolut has done fantastically well, right? Because as a fintech, as a bank, you have interest revenue, which is highly dependent on interest. And then you have fee revenue, which is like fees, subscription revenue. And for example, Revolut has done a fantastic job because if you look at the revenue mix, is highly differentiated across fees, interest, and other things. So it doesn't matter what's happening in the macro environment, they are better prepared than others because they are so well diversified that they're gonna take advantage of any type of situation, right? And they can navigate uncertainty in much better than others. And then also on the products, depending on the type of lending you have, you can also take advantage of the very high interest rates.
Okay. And how would you do it? Like if the interest rates are like super high, like how do you take advantage?
Well, I mean, you can target like shorter term lending where people are more, open potentially to have higher interest rates.
Okay. And when the valuation of Klarna was went from like 45 to I think like 15, like how exactly do you manage like your investors? Because I think it happened to a lot of startups, I mean scale up, especially in that era where they had to do kind of a down round, etc., etc. But internally, like how do you have like these discussions with the board? Like, are investor protected with I don't know, like preference share, or like kind of like how do you make it work for everyone basically?
So what I would say, it really depends, right? And that was one of the strengths of Klarna, right? Klarna never raised preferential shares or never issued preferential shares. And this is another thing that I think people don't really know about fintech and banking, right? If you are a bank, like a regulated bank, right, and you are subject to capital requirements, which means that you need to put aside a lot of equity to comply with some banking ratios. Like, I'm not going to go into the details, but there are ratios you need to meet in order to be able to keep operating as a bank, right? And
So basically, you
it,
need to have like some cash available for like certain reason. Let's say like
yes,
because you're a bank, so you need to operate and have like certain cash on your balance sheet.
yeah, for
Okay.
prudential, this comes to Basel regulation, to prudential rules, where because you are responsible for the money from the public, you need to have equity against your assets in order to meet these requirements. What these rules say and is that if you have preferential equity, so equity which is linked to preference shares, you cannot account fully for this equity against the criteria. So if a company like Revolut raises 1 billion, for example, and that 1 billion is common shares, then the full 1 billion can be used to comply with the rules. So all good, everyone happy, right? But if the 1 billion is subject to is a true preferential shares, then actually that 1 billion does not count to comply with the rules. So it's kind of useless. So it's great you raise 1 billion, but it cannot be used to comply with the regulation, and therefore it loses a lot of value. And that's why you had cases like, for example, Klarna never issued a preferential share, so always had common share, which is great from a regulation point of view. And then you had cases like Revolut that at the early stage they issued some preference shares, but then when they became regulated, they decided that, hey, we cannot do this anymore, and they issue only common shares, right? And then as you grow and become public, you can have a mix of the two because you have so much equity that you can optimize, right? Because obviously common share is more expensive, because that's another thing people do not realize that happens and had happened during the bubbles, right? There is imagine you have two companies that are identical in tech. One issues only common shares, and one gives you the opportunity to buy preference shares. Which one of the two do you think is going to have higher valuation?
Yeah, the one with the preferred.
Exactly. So you had a lot of companies which they were raising they became unicorn, but they have a very high preference share thresholds. And then what happens is when the market turned upside down, because of the preference thresholds, they became what we call zombiecorn. They are stuck, right? Because they cannot raise at any valuation similar to the last round. They have these preference share thresholds, which now put them in a corner, right? While if you issued common share, yes, you couldn't raise a so high valuation back then, but you are free now. You don't have this preference threshold, behind you, right?
So your advice, like for founder, would be to never raise preferred and always have
No, I
common,
mean,
or
no, I think it depends, right? So prefer, and you never know, but obviously prefer is cheaper cost of capital. If you have a strong foundation as a company and you avoid raising a too high valuation, you can be smart that you can slightly better predict the trajectory, and prefer is great if you minimize the risk of down round, right? But if you go too far with the prefer, then you can be in a tricky situation, as it happened for many companies in the last few years, right? So I don't think there is a one size fits all type of rule. You need to optimize between dilution and other considerations. But I think some people went too far with the preference shares, and then they say, I would rather raise at 1 billion with high preference thresholds than not raise at 600 million, because obviously you want to become a unicorn. There are other type of incentives there, but I think a lot of companies underestimate how bad can get if you raise a too high valuation with too high of a preference thresholds. And I think actually that's another big learning from working with public companies, is how do you manage downside scenario, right? Because I think in tech, and which is great, I love it, I'm a positive person by nature, there is always this extreme positive attitude, which is amazing. But I think a lot of people, they don't know, they haven't seen how to manage downside scenarios. So sometimes they take risk a bit blindsided without understanding what that means, right? I think deciding between common and preference is one of the things that in some case preference makes sense. But I think people should think deep before making the decision rather than just go for it, right?
and when you have like a down round and it's only common shares, like how does that work from a board perspective? Like, does the board has to approve the down round, or is it something that the founder can decide? Like, I'm guessing it depends on the shareholder agreement, but how exactly is something like this decided internally? Because as you said, like it's super important to manage your downsides. And I assume that when you invested in a company at a super high valuation with common shares and they decide to do like a down run, it means that you're losing money. So like how exactly do you balance that negotiation with the shareholders?
Well, I mean, I would say every case is quite different. Definitely, the board is involved in this type of things. There usually is a deep discussions between the board and the founders, and you also need to be strategic, even that, right? Because every time you raise money at specific valuation, you need to think about the next round, right? So if I'm a company which was valued 1 billion, let's say back in the days, and then I say, hey, I need to do a down round at 500. I think you need also to think very deeply about what's the next round and what's your ability and your conviction to get to the next round at the valuation which makes sense for your investors, right? Because if you were valued 1 billion and then you do a down round at 500, you have a new investor, let's say you want to be my new investor at 500, I need to give you enough buffer so that you can make money, from my specific situation. Just like, hey, if it's 500 today, do I have a clear path to 800 or back to 1 billion in a couple of years? Because that's the math you as investor will do. It's like, hey, I'm gonna invest at 500 only if I see a path to go back to 800 or to 1 billion. So there is every time you do, and that's I think another learning over the time. Every time you do these double transactions, it's not about the transaction per se, but what does it mean for the next transaction, right? And the next transaction could be a new round, could be an IPO, because you always want to give buffer to the investors, and also you need to make sure you convince the investors. So if the valuation is too high and they don't see the upside, they simply will not invest on you, right?
And how exactly do you like manage your relationship with the founder or management? Because obviously for people who are already shareholders, they want to maximize like their upsides at every round. Like some people might do like secondary, etc. So you have like essentially different, I would say, yeah, everyone has different needs. So super early investors would want maybe this round to be at the highest valuation because they want to exit half of their position. Maybe the founder wants to do cash out. Maybe the founder doesn't want to get too diluted. So how, as a CFO, because you're the one who's going to prepare for the next round, so how exactly do you manage everyone's expectation and make sure that the valuation is not too high so the investors are actually like in it for an upside and are not just like the bottom of the one paying the highest valuation, basically?
Yeah, I think another very important thing that's part of my job is to truly be close to those investors, right? Is to listening to their needs, to their feedback, because as you said, everyone has different needs, right? Someone might be, they're very patient capital, so it's all good. Some others, maybe they've invested in your company a long time ago, and now they have their own LPs pushing for an exit. So how can you help those investors to make an exit? Sometimes you can do it, facilitating a secondary or either through employees or with other investors. In some other case, you need to explain what the situation is, and you need to help them managing their own LPs, right? I think the best way as a CFO is not understanding only your investors' needs, but your investors' LPs' needs. Because at the end, my job as CFO is very similar as the job as a GP in a fund, because I'm managing my investors, the GP is managing their own investors. And often those needs and those questions are quite similar. So the better you understand what's going on in the LP population of your investors, the easier it's going to be for you to support your investor. And also to build that empathy, understanding, because a lot is also managing emotions, particularly in volatile markets. You need to be able to, to keep calm and to inject that calm across the investors so that they can, keep and manage their own LPs, right? But I would say, yeah, communicating and managing them actively is very important. That's why I would say one advice to fund, I would say try to keep your cap table manageable and not too crowded, because now, for example, at DeepL, I'm very lucky because I have a fantastic cap table. It's very concentrated, so I don't have hundreds of investors, so I'm able to manage them almost one-to-one. I can have catch-ups and one-on-ones, but then if you have 100 investors or 200 investors, it's impossible, and then things get much more complicated, right? So I think it's good to have a more concentrated cap table if you can.
And why did you chose DeepL? Because you had a lot of choices. I assume you've worked at amazing companies, did IPOs, etc. So why did you decide to move to DeepL?
Yeah, I think several reasons, right? First of all, is the sector, right? So when I was definitely too young when internet came up, right, in the early 2000s. Then I missed the mobile revolution because I was in banking and AG back then. Now is really the era of AI. So I say I don't want to miss this train, right? I'm young enough, and really I want to be an active part of this new revolution. I want to be in the driving seat. So the fact that DeepL is a global AI company built in Europe was definitely a big um, incentive for me to join. The second one is Yarek, right? I'm a very privileged because alongside, in my career, I worked alongside amazing leaders, both CEOs, CFOs, founders, and Yarek is an amazing leader, right? He's a scientist, so deep thinker, technical founder, but also most importantly is a great listener, right? Is very humble, down to earth, and he really is a great leader that can really trust others. And he has built a fantastic team around him. So being part of this team, a word from him, was definitely another big plus. And then another reason was the cap table, right? Uh, having being a CFO in a company where you have in the cap table investor like Benchmark, Index Ventures, IVP, Iconic, B2 Venture, GIC, Itomico, Ontario Teachers is a cap table second to none. So the opportunity to work alongside these great investors, learning from the best, from legends in the industry like Matt Kohler and Danny Raymer and others. Again, fantastic opportunity. And then last but not least, I truly think, there is a huge opportunity in AI. There's a huge opportunity in Europe. So being part of a company which is still in the middle of this journey, it was an opportunity I couldn't say no to.
Yeah, super interesting. And I'm quite curious because I think I heard you discuss also about the costs related to AI, and we're seeing this, with I mean, there's a lot of controversy around the models requiring more and more compute. Like some people say that they will never be able to become profitable, etc., etc. Like you've been in companies that were banking and based on software, and now you're like in an AI company. Can you maybe like give the difference in terms of cost, and how exactly do you like balance the cost of AI, and what's the long-term vision, and how do you make it align with the financial prediction, basically?
Yeah, obviously from a financial perspective, the business model is quite different, right? And I would say credit to fintech. I would say as a CFO, as financial operations, I think in terms of complexity or sophistication, nothing beats financial service and payments. The complexity there is huge. And it also comes from the regulations and all the constraints you have, right? Imagine if you are a bank or a fintech, the volume of transactions is in the order of billions every day. And if something goes wrong, you are in big trouble with, regulators and stuff, right? So I think from a financial operations, I would say fintech and financial services is more complex. But what is more complex in AI is really the uncertainty about the business model, right? Like for example, think about billing, right? Now there is a big debate in the industry and nobody has an answer yet. What's the best billing revenue model in AI? Is it the traditional subscription per seat model? People is now starting to think maybe it's not the best for the AI era. Then you have usage-based billing, which a lot of companies, including us, are adopting. And then now it's like people shifting towards outcome-based billing, right? Can you bill based out of an outcome, right? So this uncertainty in the business model makes very difficult also to forecast, because how can I forecast my revenue in the next 5 years if we don't even know in the industry how everyone is gonna bill the customers? If it's per seat, per outcome, user based. So there is a lot of variables coming into play, right? The second one is like the capex, right? As you said, the big LLMs are spending billions and billions in development and training these models. Here there is a very fascinating debate going on in the industry. Some people say, those three companies are playing a different game, and they have so much funding, and they're gonna lead like the technological advancement, and then all the others will have proprietary models and specialize on something rather than having horizontal models. Others, very non-consensus investors, they think, hey, maybe we are too early in the industry, so that something very severe is going to happen at some point, and then there's going to be a reset like we had in the dot-com bubble, right? I hope it's not the case, but I've spoken to some investors who think that could be the case, right? And
Why do you think
from
it's
our
like? What do you think it's the biggest difference between like the dot-com bubble and what we're living now?
I think, personally, I see now the impact on the ways of working and on the business models seems to be much more clearly defined. Also, the ability of AI to be applicable to substantially everything in much faster way. I think it's clear AI is here to stay. It's clear it can make a huge impact on productivity. While in the dot-com, obviously, there was the fragmentation of things that were popping up was, I think, a less of a clear use case. But again, I was maybe too young to compare, because back then, to have a proper comparison of the two. But when it comes to AI, I'm very convinced. This is here to stay, as there is not a bubble from a technological point of view. If there is a bubble from a valuation point of view, that's a different story. But I think the technology is real, and the technology is here to stay, right? And I think those companies, and DeepL as well, like leading the charge and disrupting those industry from within, it is something which will have a lasting impact. And I don't see whatever can stop this, right?
And what do you think are
Which,
like the biggest threats to DeepL?
well, obviously, it's an extremely competitive environment, right? And I think everyone playing in AI and knows this, right? I don't think anyone is safe, right? I mean, uh, we hear a lot about all the fantastic work, for example, the legal AI companies are doing. And then every other week, though, the general models are issuing like legal features. And it feels that whatever you do, you have one of those big three, four that can uh, easily replicate you. I think so. It's being extremely focused, keeping calm, and but again, I think one big mistake we should avoid in general is trying to be suffering too much from this FOMO and go out and trying to build too many things. Because as you said, this is very expensive and the capital is limited. It doesn't feel is limited, but it is. So I think you need to be focused on real problems that the customer has and be the best at solving the specific problem and having a solution which has a lot of business context, very embedded in the critical workflows, so that then you can truly make a difference and you can be defensible. Because if you are a solution which is easy to switch, then that's where trouble comes, right? And I think that's where a lot of companies will need to be very smart on how they build the solutions, right, around the problem of the customers.
Yeah, I agree. And I know we're almost like out of time, so I think this is gonna be
Yeah.
my final question. If you look at your career so far, like what are the things that you would have done differently, and also why?
I think, to be honest, I truly love private markets and building and scaling companies. I think going back, I would have switched to private market earlier in my career, right? I spent 11 years in public companies before switching to the private dark side. I think going back, I would have definitely maybe moved, I don't know, after 5, 6 years in public companies, I think it was enough. I should have switched to startups and scale ups earlier in my career. That's definitely, and I think that's one is my personality really fits private markets. I love building things and experimenting and building and breaking, rebuilding. And I think this is more a private market startup type of thing. While in public companies, you have a lot of constraints and limitation of what you can do or cannot do. So I think I would have enjoyed if I'd switched to private companies earlier in my career, so I could have unleashed myself a bit earlier with these type of things.
Okay, and what do you think are like the constraints in public markets that people are not usually aware of, but that you don't like particularly like?
Yeah. Well, obviously, is all around the quarterly reporting. So everything is optimized a bit for the short term, which means you don't have much time to think about medium and longer term. And and obviously, in a public company, you have less room to experiment things because there are much stricter rules in the way you report things, you present things, right? I mean, when you are in private markets, if I want to report to the investors in a totally different way, it could be even an app, right? Now I could do an app on cloud, send the link to my investors that they can play with it. As a public CFO, you cannot do that, right? It's not like you cannot test the water, do A/B testing. You need to play very safe because obviously there are a lot of regulations you need to comply with. In private markets, you can really experiment and try to change the status quo in a way that in public companies you cannot do it. In fact, if it's true, as I read yesterday, that there is appetite from SEC to kill the quarterly reporting requirements. If this is done right, I think it would be a fantastic move so that the public companies can focus more on a medium and long-term strategy rather than optimizing quarterly results. Because I think a lot of companies had made the mistakes just to please the public markets to avoid investing for the long term because of the public pressure, right? Only a few companies like Amazon and Apple had the courage, but also the strength to say, I'm not gonna issue dividend. I don't care. I want to invest for the long time. I'm gonna redeploy the cash for innovation and technology. They were able to do it, but a lot of companies, they were doing a lot of buybacks or issuing dividends just to please the short term. But these were billions that could have been used to innovate. I mean, that's what happened in banking, right?
Yeah.
Revolut is doing a fantastic job. I'm a big fan of them. And one of the reasons they are winning so big is that the traditional banks, they have wasted so many billions in buybacks and dividends in the last 20 years, all billions they could have been used to innovate and disrupt their own business model. They have not that because they've been very focused on the short term. And now companies like Nubank, Revolut, they are eating their market share like crazy.
Yeah, I agree. And I think it's too late for them also. Like now
Yes,
it's
I agree.
yeah,
I agree.
it's they will never go back from that. It's not in their DNA. They can't innovate, so it's they're gone.
But they had the cash to do it. If
Yeah.
they, but
Mm-mm.
they wasted the cash for buybacks, dividends, and now it's too late, as you said.
I agree. I mean, Martino, thanks a lot. I think it was a super interesting conversation, and I'm super happy that you joined Billions. Where can people follow your updates or deeper updates?
Yeah, I'm very active on LinkedIn, so everyone can follow me, DM me. I'm very open, always keen to learn best practices and industry insights. So follow me there.
Okay, awesome. Thanks a lot, Martino. Have a great day.
Thanks a lot. Bye bye.